2020, in came the COVID pandemic, and it did reveal just how interconnected the world is. As you saw, the pandemic spread from patient zero in China to Asia and eventually to the entire globe, affecting us or impacting all of us, not just socially, culturally, but also to a very large extent economically. And with that, we now find the world grappling with new challenges. And as we speak, we are standing on the prefaces of a possible global recession. And there are a lot of this actually coming off from the stifled demand. We are seeing rising inflation. We are seeing supply chain constraints. We are seeing a lot of geopolitical tensions. All of this playing out in the global space. And of course, coming to impact us right back here at home. And to this end, we see not only how the trifecta, inflation, war, and interest rates are going to affect us, but also what our government is doing to try and ensure that they do cushion us from these impacts. And starting us off, we'll be looking at inflation. Inflation, the silent thief, always eating away on the investments. And the question that we start with is what exactly or what is the deal with inflation? Inflation is a rise in the cost of living. And this has, while inflation may seem not a very good to have, it is ideally a necessity. It is required that a little bit of inflation is there, because it is through inflation that companies are able to adjust their cost of goods and services. It is inflation that actually allows for institutions to even adjust salaries. So a little bit of inflation goes a long way in terms of ensuring that the global world or the global economy is actually growing. And we have two major types of inflation. One being the supply-driven inflation. This is a situation, or this is a scenario whereby the inflation is being driven by the fact that the quantum of goods and services available are actually limited. So what you have is that there is an issue on the supply side. The second type of inflation that we face is the demand-driven inflation, or as others may call it, demand pull inflation. And this is usually a consequence of a heated economy. A heated economy in the sense that you have too much cash chasing few goods and services. And inevitably, you find that this will cause the prices of these goods and services to actually tick upwards. So currently, what we are seeing on the global space is that we are seeing a rise in inflation, and I'll be taking you through what we see in different countries. Food prices have been ticking upwards. A lot of this being in part driven by supply. The geopolitical tensions that we've seen in the Europe zone has had an impact in terms of the price of wheat, in the price of corn, in the price of petroleum. So we have that driving the supply side.
The options. I think possibly I need to revisit a prior model in terms of looking for concessionary loans from multilateral partners, as had happened before. If you look at where we were, say, 10 years ago, 15 years ago, that was the kind of model that we were applying, and of course the rates are much lower than those of the more market options like the syndicated loans. So I think maybe, in our view, an opportunity to revisit that model. Of course, it comes with significantly more engagement with these partners in terms of economic policy, and therefore we expect that it will be more of a long-term situation in terms of those engagements, in order to ensure that we are able to get the best option for the government. But clearly, there's obviously a need to, in view of the development that you've mentioned, very high levels of yields on Eurobonds, and it cuts across the global markets. And I think, therefore, that is something that the government will need to look at.
trust you to ask for hard figures and not soft issues. When it comes to inflation, I think the view is that upward pressure will persist, especially coming from the fuel costs. That will put further upward pressure, heading to perhaps the 8.5% range. When it comes to the central bank policy, we predict that the central bank rate will be increased by between 50 basis points and 100 basis points. That's 0.5 to 1%. As regards the stock market, our view is that it could remain depressed for the long run because of global investor sentiment. So there's talk of a recession oncoming in the US, and which will be coupled by probably a global recession, as George mentioned. So we think that the key driver for the depressed stock returns will be really the global sentiment, with the US economy slowing down and possibly going into recession. And it impacts our local market as well, because as you're aware, foreign investors also invest in Kenya. So we think it's global market sentiment that will keep stock market returns depressed. But we are very convicted that a lot of the listed companies are very solid fundamentals. So we are not concerned about the investment rationale of investing in this company. It's just that returns may be depressed for the foreseeable future. But since the companies themselves are fundamentally sound in our views, we think they make excellent long-term investments. So this bear market provides an opportunity for long-term investors to accumulate stocks. Thank you.
As far as you're very right in terms of the kind of inflation that we are seeing, inflation that we have in Kenya is majorly imported inflation. And again, if you recall from my presentation, I did state that raising interest rates in cash-based economies such as ours does not really work that effectively or that quickly as you'd expect. And as a result, what we normally see more of is increased investments in the country. It is not more about sorting the demand side, but it's more about sorting the supply side. When you raise interest rates, you attract foreign investments into the country, and that the foreign investments does come in the form of foreign currency. So with that, I think that is one of the fast and the quicker impact that the policy will have in terms of helping with the demand, with the inflation issue. The other way that the government can be dealing with this, and we saw this, is by engaging new partners, even in terms of where we import our oil. So those are different policies that they can take up. Now, in terms of our bear market outlook, 2 years, it is also stemming from the fact that a major reason why we are having a bear market is not so much about political averseness as it is about developments out there. It is not because we are having elections. Elections, yes, have a part to play in terms of investor uncertainty, but the impact it has is not as significant as the global trends that are out there. The fact that you're expecting the US, which is the largest world economy, to go into a recession, the fact that you're having interest rates rising there, the fact that you're having a slowdown in economic growth in China, the fact that there are political uncertainties in Europe. We saw the other day Boris moving out of office due to issues surrounding his administration. Those are our main drivers. Those are the main reasons why we expect the bear market to be prolonged as opposed to